Inflation is one of the most powerful forces shaping the global economy, yet it is often misunderstood by everyday investors. At its core, inflation refers to the gradual increase in prices of goods and services over time, which reduces the purchasing power of money. While moderate inflation is a normal part of economic growth, changes in inflation trends can have a significant and sometimes unpredictable impact on stock market performance. To understand how markets react, we need to look beyond the numbers and explore how inflation influences companies, investors, interest rates, and overall economic confidence. When inflation begins to rise, the first and most immediate effect is on consumer spending. As prices increase, households find that their money does not go as far as it used to. This often leads to reduced discretionary spending on non-essential goods and services. For companies, especially those in retail, hospitality, and consumer goods sectors, this can translate into lower sales and shrinking profit margins. As a result, stock prices of these companies may come under pressure as investors adjust their expectations for future earnings. However, the relationship between inflation and the stock market is not always straightforward. In some cases, moderate inflation can actually signal a growing economy. When demand is strong enough to push prices slightly higher, companies may also experience higher revenues. If businesses can pass these increased costs onto consumers without significantly reducing demand, their profits may remain stable or even grow. This is why the stock market does not always react negatively to inflation. It depends heavily on the level and stability of inflation, as well as how well companies can adapt. The real challenge begins when inflation becomes too high or unpredictable. At that point, central banks often step in by raising interest rates to control rising prices. Higher interest rates make borrowing more expensive for businesses and consumers alike. Companies may reduce expansion plans, delay investments, or cut costs to maintain profitability. For stock markets, higher interest rates can be a double-edged sword because they reduce corporate earnings potential while also making bonds and other fixed income investments more attractive compared to stocks. One of the most important concepts to understand is the relationship between inflation and interest rates. When inflation rises, central banks like the Federal Reserve or other monetary authorities typically respond with tighter monetary policy. This includes increasing benchmark interest rates. As interest rates rise, the cost of capital increases, which directly affects company valuations. In financial models, future earnings are discounted at higher rates, leading to lower present valuations of stocks. This is one of the key reasons why stock markets often decline during periods of aggressive rate hikes. Technology stocks and growth-oriented companies tend to be particularly sensitive to inflation and interest rate changes. These companies often rely on future earnings potential rather than current profits. When inflation rises and interest rates increase, the value of those future earnings decreases in today's terms. This is why during inflationary periods, investors often shift away from high-growth tech stocks and move toward more stable, value-oriented sectors such as energy, utilities, or consumer staples.